Hi guys. So on that note of at the end of part one, we had said that realistic returns are between 20 to 30% a year, not 10% a week, not 20% a month, 30% a month. It's unrealistic to aim for those kind of results, and especially knowing that the greater your risk per trade, the higher your chances of blowing. And this is another chart he puts in his book, Way of the Turtle. Right, let me just show you for a second. So on page 109, on page 99, you can check it out for yourself. On page 99, he essentially shows you the graph of a profitable, realistic trader, and what you get to see is that he has a lot of losing months and a lot of really, really, really good months. And so what a lot of them don't tell you is essentially that you're gonna have 4 months losing trades in a row. You're gonna have losing months, quarters even, which you're losing, but you can still be profitable even with a losing quarter. What I don't necessarily support is the idea that you can double, triple, quadruple, and do that consistently. It will lead to a cycle where you will deposit $100, you will trade it and try to double, triple until it gets to 1,000, and then you're gonna blow at some point, and then you'll deposit another 100, and then you'll try do it again and again and again. And it's not a good cycle to get involved with. I personally believe, maybe I'm wrong. Another point he has in his book, which I think is really important, let me just get there. Right. If I can just find it. Right. Here we are. So on page, let me just get to it, sorry. On page 60, here we go. So on page 60, he talks essentially about the shape of your graph as you're supposed to be trading, and what your long-term graph looks like. Even though you have lots of losing trades, you actually have more losing trades than you do have winning trades. And so he sets out the whole graph for you, and shows you what a profitable trader's graph looks like. It has more losing trades than it does winning trades. But the difference in why they're profitable consistently is that their losses are managed. And so all of their losses are below 10%. Their drawdowns are below 10%. So when I say losses, I don't mean one single trade is below 10%. I mean that cumulatively, when they have a losing streak, it's all below 10%. And then they have random 30% wins, 20% wins, without increasing the size of their positions or their leverage. That's very important. They stick to their risk management. They have 30% wins, 20% wins, without increasing the size of their positions. And they make sure that their losses are below 1%. So when we traded, we did not measure our personal worth by the outcome of each trade, because we knew it would most likely be a loser. We thought in terms of probabilities, and it gave us confidence that decisions in the face of large degrees of risk and uncertainty. So in the long run, they were so sure that they would make money because they had a positive expectancy system. And so here's the graph where he shows you the losing months and the winning months. And essentially the winning months outweigh the losing months, even though there are tons of losing months, which is crazy because a lot of people don't actually tell you. And here's the kicker. This is the part I really, really thought that a lot of people would love to hear. Right. So on their system, they had, for example, 3,700 losing trades, right? And then they had 1,800 winning trades. So they had 3 times their losses. Hear this. They had 3 times the number of losing trades, and a third of their trades were winners. But they were still profitable. So realistically, your win rate doesn't actually matter. And so this was based on 22 years of testing. Based on 22 years of testing, 3,700 of their trades were losing, 1,800 of theirs were winning trades, which is absolutely insane. And that's exactly how a lot of your trades are going to be. You're going to have more losers than you are winning trades. And I'm sure a lot of people don't actually tell you that. And you should know that, because when you start to see losers, and then you start to wonder, why are you losing? Why aren't you profitable? Why aren't you in the Lamborghinis? It's because you're trading well. It's just that you've been sold this idea that you can make 50%, 60% of your account in a month, 2 months, once you're an expert trader, which realistically isn't true. And here's his history. Here's his trading history, right? By the way, if you go to page 51, you'll notice that he has 17 losing trades in a row. And then on his 18th trade, he made 75%. And then he had another three losing trades. And then he had a 70% win again. But what's important to know is that the size of his positions didn't change. He didn't increase his risk, he didn't increase the size of his positions, and he didn't increase his leverage. It's just having a positive expectancy strategy that you've tested, and knowing in the long run that your trading system will win. And just to close off, guys, you can really check out a lot of what he was saying here in this book. The last point I wanted to talk about, page 49. Right, sorry. Okay, so in the last point I wanted to make, that he was essentially saying, was that almost 70% of your trades will be losses, and that's a lot of the times a lot of people don't say. So 70%, and this is even, I've done videos on this. I think I titled it "The Most Important Lesson in FX," which is that these people had been trading for years and years. They became millionaires. And he's saying that they lost 70% of their trades. Literally, they lost 70% of their trades. They only won 30% of their trades, and they were still really, really profitable. And that's what you should know. Beyond everything, your win rate doesn't matter. What ends up being really, really important is the fact that you have a positive expectancy ratio, and that on your winning trades that you win 30%, you make up for all your losses. You don't increase your position size. You just make up for your losses because you have a positive expectancy system. Right. So his exact words were, "It may be typical for a trend following system to have 65 or 70% of losing trades." And then when he shows you his history, you get to actually see that he did lose 70% of his trades. But it appears that our gurus never have any losing trades. A trend following system is expected to generate a 30% annual return, right? And you can expect a losing period in which the account may drop for 30%. So you can expect to have even a drawdown of even 30%, and to have 30% as your annual win for the year. So that should be your target. Your target should be making 30% a year, not necessarily doubling, tripling, or quadrupling your account.